Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. I'm so pleased you decided to join me today for a few minutes. As you know, this is our monthly check-in to have a conversation around money and meaning. And when I think about money and meaning into the context of this show, what we try to do is have conversations around uncovering what gives you meaning and purpose and joy as you approach your second act. But to do that, we also need to bring in the capacity. How do we create the financial means to go live the life that we hope to live in our second act? And so we combine in this show these deep discussions around meaning and purpose and how do we find joy in our life with technical wealth management expertise. And I got to tell you, today I'm really excited about our guest because this is a subject that I think is a lot misunderstood often. You know, in my book, The Money and Meaning Journey, I talked about the six financial challenges that my hero, which are mid to late career executives, as they transition to the second act, that they're likely to face in today's world. We've got potentially lower expected returns because markets are not inexpensive. We've had historically low interest rates, although that has improved a bit with rising rates. We're living longer. Healthcare costs are skyrocketing, are a major challenge. Confidence in government programs like Social Security and Medicare is certainly a concern. And then finally, many investors make behavioral mistakes or behavioral inappropriate decision-making around how they manage their portfolio, which could affect their long-term retirement income stability. And so today, I'm really pleased to have a guest on that has some tools and techniques that address many of these challenges. So let me introduce my guest today. Today, I have on Gabrielle Welter, who is a retirement solutions manager with Finance of America. And she is an expert in coaching advisors primarily on how to apply some of the creative reverse mortgage products to unique client circumstances. Many of you have probably heard of, quote, reverse mortgages, but I've got a feeling that today you're going to learn some things that's going to help you think differently about them. So, Gabrielle, welcome to the show. I'm really, really excited to have you on.
Thank you so much, Jeff. I'm so glad to be here. I'm just grateful for every opportunity to spread the message about reverse mortgages and accurate information, and that they're actually a safe and strategic vehicle that can be used in retirement planning.
Yeah, well, I'm so pleased to have you on because, you know, we don't get a lot of questions about it, but oftentimes when we do, they come from a lot of misinformation and myths that I find in the marketplace that we'd like to kind of take a look at some of those. But let me start, first of all, as I usually do, I love for the audience to get to know you. So tell me a little bit about yourself and your family and also about your career path and how you found yourself in this role.
Okay, so I'll start with I am the mother of three incredible boys, 22, almost 19, and 16. And I leveled the playing field a little bit there with all that masculinity. I have one female golden retriever named Journey.
Well, I was the youngest of three boys. So,
Oh, you were?
Yes. And my mother was the same. So I know you have your hands full.
I was not the youngest. I was the middle of three girls. So I figured if I did have a girl, I had a lot coming to me. So I dodged that bullet.
Yeah. Yeah. Well, three boys, that's a lot.
Yeah. So, well, as far as how I got started, I started out in the insurance business, and I actually started a scratch all-state insurance agency. And I ran that for a little over 5 years. And then I sold it, decided I wanted to do something. I think I just was looking for a little fulfillment as far as, you know, educating people on insurance wasn't that stimulating, you know, and I didn't know that I was going to end up in reverse mortgages, but I had a lot of contacts within that loan officer industry, you know, for referrals for insurance. And so I ended up getting licensed. And like so many others, I didn't have a very positive opinion of reverse mortgages, and it was based on a lot of misinformation. So when I was exposed to the product and started to learn about it, I just fell in love. And I was like, oh my goodness, if there was so much about it that I didn't understand and didn't know, this must be the opinion that others share. So I just developed this real passion for it. And because I see what an amazing tool it can be. And that led me to where I am today, educating and talking about it.
Gotcha. Okay. Well, cool. So before we get to Finance of America and some of the details about reverse mortgages, this show is all about helping people figure out their why. What is their purpose? What gives them meaning? What gives them joy? Because all the financial stuff that you and I do is a means to an end. In the end is to live a great life and to feel significant and enjoy the journey. So this is pretty nosy, but what is your why? What gets you jazzed?
The reason I'm doing what I'm doing is because there are so many advisors and seasoned citizens out there that aren't utilizing the product because they are afraid of it or they don't understand it. And honestly, sometimes I feel like I'm swimming upstream, in the profession I've chosen, but it gives me a lot of purpose when I see the light bulb go off, when I see somebody realize, oh my goodness, I didn't know that. And this can actually be something that really changes somebody's retirement. And not to sound cheesy, it can be a really big deal. And when I functioned in the beginning as a reverse mortgage loan officer, closing the loans myself, not just educating, I got to sit at the kitchen table with these seniors, and explain everything to them and see the peace of mind that it brought. And that it just drives me, Jeff, because there's such underutilization of the product. So, you know what I mean? There's a lot to be done.
That's great. Well, that peace of mind, I mean, that's, we crave in retirement, especially, I mean, we want dignity and independence in retirement. And because of some of the challenges that I just mentioned in my little intro, it's not a slam dunk. I mean, we've got to think differently. Many of us have to think differently about what do we do to create a rising income stream over a 30-year period from a holistic balance sheet, not just the asset side of the balance sheet. And so I think there is a lot of misinformation. So I'm glad to have you on. So first of all, I in our industry, and when you hear people on the street speaking, sometimes reverse mortgages do get a bad rap. So tell me why do you think they get a bad rap? Why do reverse mortgages get why is the perception not always positive, do you think?
Yeah, I really believe that it goes back to when the program originated, some regulations and safety measures that weren't in place. So people were taking reverse mortgages out. Sometimes it would be, if you think, back 20, 30 years or whatever it did, or even longer now, the husband would be the only one on the loan. And that was common, and it didn't require for both borrowers to be on the loan. So when the husband passed, and if he passed earlier, which statistically is often the case, then the loan became due because it's due when the last borrower passes or moves out of the home permanently. So that left some, widows in a predicament, and where now they were living in the home and it was due. So since then, now there's a safety measure in place where both borrowers, both the spouses, they're required to be on the loan, whoever's on title. So that protects a widow, be it male or female, from being left on their own with that loan to come due. I feel like that is the biggest one. There was also some predatory lending going on where, not everything was explained properly about the loan. And by that, I mainly mean there's no payment due on these loans. We'll talk about that. But you do have to pay your property taxes and homeowners insurance, right? So if that wasn't, thoroughly explained, and we're dealing with the senior market, then sometimes those were left unpaid, and that also would cause foreclosure on the loan. So another safety measure that's in place now is a mandatory reverse mortgage housing counseling session that takes place typically over the phone that the borrower has to go through, where they double check and make sure that the loan officer has, crossed all their T's, dotted all their I's. They understand everything about the loan, and it ensures that the borrower is competent and of sound mind. There's a certificate issued at the end of that, so that eliminates some of that exposure, for predatory lending. So those are two major changes.
Yeah. Well, so legislation has improved the marketplace, cleaned up a lot of the questionable practices, and of course created the new HECM, which is obviously what we'll talk about here in a few minutes, which I think was helpful. I think as an industry, oftentimes our perception is it's only as a last resort. So I think because of the advertising on TV, people assume that the only people that do reverse mortgages are people that don't have any other resources, and that's why they do it. And so people in the financial services industry assume that there's not other features that make it a more useful tool for more than just as a quote last resort. So I think that could be an issue too. I believe, because I think about when you look at a client's balance sheet, it's you really have to look at their entire balance sheet. And, sometimes there's a fear that we're going to disinherit our children because we don't leave them the home. Well, if you use the equity in the home, but you leave them a larger portfolio or a larger IRA, oftentimes they're better off. So it's not whether they get the house or they get the other part of the portfolio. And secondly, I mean, the goal from my standpoint is that my clients remain, again, financially independent, so they don't have to rely on their children. And if a reverse mortgage is a tool that can assist in that process, I think you don't want to ignore it.
I'm so glad that you mentioned that exact phrase, the loan of last resort, because that is kind of a nickname that it's been assigned to the reverse mortgage, and it's actually the exact opposite of how we want advisors to think about it. Like you said, so it's when implemented early and strategically, the legacy left can often be larger. And we actually have a tool that we run through the advisors with, and you've seen it, Jeff. You and I have done illustrations together. Yeah. So you can actually see how much equity is remaining 10, 15, 20 years down the road. It's not a hard and fast number because it's an adjustable rate, but it gives a great idea that contrary to what a lot of people believe, there's often a significant amount of equity remaining in the home.
Yeah, well, and we'll get to that too in a moment. So why do you think people are more comfortable liquidating financial assets than they are liquidating equity in the home? Because that's a psychological barrier, I think. So we save money in our 401k for 30 years, and then we draw it down over the next 30 years. But we've also accumulated equity in our real estate, but we don't draw it down.
I think it's expectation. So I think that when you change the way you look at something, you change the way it feels. So when we're contributing to our 401ks, often from our first real job, right? We start, putting money in there. We do that knowing and expecting that later in life, that is going to be a source of funds for us. And our Social Security check, we expect to have that, and that is going to that is going to be how we are going to help pay for our lifestyle. But we don't look at the home that way. Even though there's so many people that right on top of their list, like, financial success is be mortgage free and pay it off. We don't look at what can the home do for us when we've accumulated all that equity and value. So if we could get more people thinking about it differently earlier on, way before retirement, then I think that would help with combat the struggle to tap into that equity and use it.
Right. Well, let's get into the nuts here and bolts for a minute. So tell us what a HECM is and how it works.
So HECM stands for Home Equity Conversion Mortgage, and this is an FHA insured loan. So it's put in place, and it will allow a borrower to access a portion of their home's value and make it liquid so that they can use it. And it's similar in some ways to other mortgages, like a cash out refi or a home equity line of credit, in the sense that you're utilizing some of your home's value. Two of the major differences are that there is not a payment required back on the loan. It's deferred until the last borrower passes away or leaves the home. That's the maturity event that is the end of the loan. It's paid back by the house. And then the line of credit has a growth factor attached to it. So those are two of the big differences.
Yeah. Well, another big difference I find too is I just remember back during the great financial crisis, many people use home equity lines of credit strategically because they didn't want to liquidate their portfolio for short-term cash needs. So they would take out a home equity line of credit to, do home improvement or to invest in a business or to loan money to their children or whatever. And what we find is that when you need it the most, you can't get a home equity line of credit because the banks won't lend it anymore. Whereas the HECM, you have access to it. It's guaranteed that you can access that liquidity.
Yes, it is another excellent point. It is once the HECM is in place, it's there for you to use. It's not going to go away. And even in like 2020, when individuals had lines of credit on their home, there were banks that called and froze those lines of credit. It happened that recently. So that is a real issue that we could be faced that doesn't exist with the HECM. It's a guaranteed, once it's in place, source of funds.
So what is the age rules in terms of when you can actually put a home equity conversion mortgage on a home?
So for the HECM, it's going to be age 62 or older. One of the borrowers needs to be at least age 62 or older.
Okay. And how much equity how much access of the equity do they get?
So the way the HECM works is it is age-based. The older that you are, the more equity you can access. And it's the reason that is so that the point is that there is still a retained equity position for the borrower at the end of the loan, right? So if you're younger, hopefully going to live longer, less money is accessed up front. The older you are, you get access to more. So it's starting now, like kind of around 30-35% is what you can access starting out.
Okay, so at age 62, if you have $1 million home, you have access to around $300,000 or $320,000 of that equity, essentially.
Yeah, it's close to that. Yep, and the higher the interest rate, it's going to affect that a little bit.
Gotcha. And so that does two things. That gives you a reasonable probability there's likely to be equity left in the home when it comes due, which is at the death of the second borrower, or you sell the home and move, so you can pay back the loan. And then secondly, I guess it provides some security to the lender and ultimately the government that there's going to be equity for the loan to be paid back as well.
Right. Nobody wants this loan to foreclose. That's probably another big message that we have to get out there. The bank does not own the home. They don't want to own the home. They don't want the loan to go into foreclosure.
Yeah. So let's just do a scenario here. If you're 70 years old or 72 years old, let's say you're 72 years old, approximately how much could you access, do you think? Ballpark.
I hate to quote numbers here, but closer to 40%. I mean, it doesn't jump rapidly.
So if you've got a $1 million home, roughly you have access to about $400,000 in capital.
We'll use that, yeah.
Okay, as an example. Okay. And how could they access that capital? Could they take it as a lump sum? Could they take it monthly? Could they take it just whenever they want it and pay it back? I mean, what are the rules around pulling the capital out?
It's available in a line of credit. So you can draw any amount of cash at closing. Well, let me clarify there. It's up to 60% of the available line of credit is available in the first year. The rest of it, the other 40%, is available in the 13th month or the beginning of the second year. Again, this is a measure to help protect and control, the spending and the way the loan is used. So you could take X amount of dollars out at closing if you need some cash. The remainder's in a line of credit, and it can be set up where monthly payments, a set amount of monthly payments are automatically transferred into the borrower's account, or they can dip into it and grab some money whenever they need it. Or they can set up what's called a tenure payment option, tenure being TENURE, because that gets a little confusing.
For lifetime, yeah.
A
Long-term
lifetime payment option, right,
yes.
with it for a guaranteed amount.
Okay. And every time you draw on it, since you don't have to pay it back, you just got a loan balance that's growing, that's being capitalized. At the same time, you've got the remaining equity, and then hopefully the home is appreciating at least at the rate of inflation. So as you're pulling money out, you've got equity that's left in there, but your debt grows, your debt compounds as well as the value of the home compounds, hopefully, or grows.
Right. Your loan balance is growing. The other nice thing about the HECM reverse mortgage is you can make a payment at any time. So if you like you said, if you want to just grab money, you're gonna use it for a business venture or some home improvements, but you intend to pay it back, you can make that payment. And at the same time, it's going to reduce the loan balance and become available again in a line of credit for you to use again.
So if we have a 70-year-old who's got $1 million home, they're planning on staying in the home for life, hopefully, and they start accessing monthly income, as an example, to supplement retirement from the equity, how is that monthly income taxed?
It's not taxed because it is a loan.
Did you misspeak there?
Because it's borrowed money. Yeah.
Okay.
Yeah, because it's borrowed money, part of a loan, it is non-taxed. And that's another great point, because when a individual is making the decision as to where to draw funds from for whatever they need money for, it is, they need $10,000. It's a true $10,000 when you take it from the HECM because you don't have to worry about taxes.
Gotcha. Okay. So let's talk about a couple of scenarios. I have seen a couple of my colleagues write white papers on the way they use these tools in the context of their retirement income strategies. So for instance, in our plans, we have safe liquid money set aside for a couple years worth of spending. We call it a short-term portfolio. The balance of the portfolio is allocated to a strategy based on a client's need, ability, and tolerance for risk. But we have this short-term bucket, say 2 years worth of anticipated spending, that we replenish once a year. So I've seen people use, or at least advise using HECMs as a way to replenish the short-term portfolio during bear markets. So for instance, if we have a 2008, 2009 event, or even a 2020, COVID downturn, instead of pulling money from your portfolio when it's down, they would use the HECM to replenish their cash fund or to provide income. And when markets recover, then they would reallocate the portfolio and pay back the HECM.
Yes. Yeah, that's an excellent strategy. Right. Because you haven't really lost the money till you sell, right? So, I mean, if you can stay in the game and not have to make any big moves when the market's down, that's huge. And there's tons of examples out there where, especially early in retirement, if you happen to be faced with a down market, if you have an alternative source of funds, just a handful of times that you can draw from over time, it can make a substantial difference in the money you have remaining at the end.
Right. Well, I know you know who Wade Pfau is. He's an expert in our industry, he's written a really good book on reverse mortgages as well as and he's an academic. So he really just looks at the math. He's not really emotionally attached, at least I don't think he is, to these techniques. But, he's done some pretty interesting illustrations that shows exactly that by not liquidating your portfolio to meet the income need during the temporary downturn, it does extend the survivability, I guess, of a portfolio by being strategic. So that's an idea that people may consider with a HECM. We've never done it that way, but I know a lot of firms do. And it's something that you could certainly think about. What are some other use cases for HECMs? What other reasons do people use them?
There's several. Some would be a way to subsidize or an alternative for long-term care needs. So I talked about the line of credit having a growth factor attached to it. So if you were to implement a HECM reverse mortgage at age 62, and let's just for easy math, because the older I get, I seem to be losing that skill, it's $100,000 in the line of credit, right? That line of credit's going to grow and compound at whatever interest rate is attached to the loan. So if it's 7% interest, it becomes 107 if it sits on tap, and so on and so forth. So that can be significant over time. So you could either access some of that money to pay for long-term care policy if you wanted to, or to supplement, say you're going to self-fund your long-term care needs. So you're just going to put that in there and you're not going to touch it. You're just going to let it grow. And 10, 15, 20 years down the road, you have this larger bucket of money that you can draw from if you need to.
Let's talk about that line of credit growth a little bit more if I could. So you could theoretically put one of these on your home at 62 or older and not draw on it. But the amount you have access to grows every year at the variable interest rate that's attached to the mortgage document. Is that correct?
Yes. And this is important. This is a reason why you would look at implementing a HECM earlier rather than later. And Wade talks a lot about that too. And it is because, as you know, with most financial planning products, time, it can be your friend, time to grow. So that's what happens with that line of credit. So if you implement it early, then you're giving it time to grow. And you can do a HECM on a home with a mortgage. I just want to point this out, or without one. So even if there's a mortgage in place, there just has to be enough equity available to pay out that first mortgage. So we're in the first lien position. So if you didn't have a mortgage and your home was paid off, you've got a nice chunk that's just going to sit in that line of credit and grow and be an alternative bucket of money and source of funds, when life happens.
Okay, so let's work through that a moment again. So I've got this $1 million home. As you can probably tell, I'm a long way from 62, tongue in cheek. It's just a couple years down the road here for me. But if my wife and I were 62, we could apply for a HECM. If I had $1 million home, I'd have approximately a $300,000 line of credit. And that line of credit, the ability to tap that would grow every year at the interest rate. So 5 years from now, 10 years from now, whenever, that $300,000 access to capital just grows at the interest rate of the mortgage. So if I draw from it, let's talk about what happens when the loan is due. What are the terms when do I have to pay it back?
You pay it back when the last borrower passes away or permanently leaves the home. So then those are maturing events and the loan becomes due.
Okay. So if 20 years from now we move into assisted living or a nursing home type situation at some point in the future, at that point, the loan's got to be paid back.
Correct. Once you're permanently there, it has to be paid back. And the HECM is a FHA insured loan. So it carries mortgage insurance protection. And this is important. It's also non-recourse. And these things are important because it's the home that's going to pay the loan back. It's the collateral. That's what non-recourse means. And if there is any kind of shortage, like let's just say, you were going into an assisted living facility in 2008, 2009 or something during, the housing market crash. If that were to occur again, if the value is down and the loan balance exceeded the value of the home, the mortgage insurance comes in and pays the difference. Okay.
So again, back to that example. So in 2008, if we moved into an assisted living facility and we owe $400,000 on the mortgage, and the house is only worth $300,000, what happens?
Then the mortgage insurance comes in and pays that difference.
Okay. So we don't have to come up with the extra $100,000 or borrow it from someplace else.
you will not have additional debt and you will not pass any debt to your heirs. Because same situation you're talking about, let's say you pass away and the loan balance is $400,000 and the home is only worth $300,000. You can't pass any debt to theirs. The mortgage insurance protection is going to come in there and pay the difference.
Okay, and that's true whether you pass away in the home or you move out of the home for another reason?
Yes.
Okay. And what are but your heirs could still sell the house if it had equity.
Yeah, so many people think that, like I mentioned earlier, that the bank owns the home and they do not. So it still will pass to the heirs, and then they make the decision, what do they want to do? Does someone want to live in the home? In which case, just like if there was a traditional mortgage on the home, when your parents pass, you refinance it. If they want to sell it, then the heirs are responsible for determining what that sales price will be, and they have time to sell it. In the case where the mortgage balance exceeds, they could just do it like a deed in lieu and give the home back.
Gotcha. Oh, they could just give them the deed if it was worth less. Yeah.
Yeah, and then the mortgage insurance pays the difference.
Gotcha. So who is a candidate for these products? Who should be looking at these products?
As a consumer and advisor, when you're trying to identify if a HECM reverse mortgage would be a good fit, you're looking for any kind of gaps in the retirement. Like, do you have long-term care covered? Do you have a need to maybe delay Social Security? When we talk about, different uses for the HECM, you could use it to supplement a paycheck so you can push Social Security off a little bit farther. Are there modifications to the home that need to be made so that you can stay in the home and age in place? Those are just some of the examples of, just basically gaps. At the end of the day, it's an alternative source of funds. It's your money, your value that you've built up in the home that, as it sits, if you're just sitting in a paid off home or with a traditional first mortgage, is not accessible. And this makes it accessible without that requirement of a monthly cash outlay, for a payment.
Yeah, there's no required payment.
Yeah. And, Jeff, I think it's so interesting because it's like I talk about changing the way you look at it and it changed the way it feels and expectations and expecting to use the home. But I think some people don't really recognize that they're already bought into using home equity on some level, right? Through a cash out refi and through a HELOC. I mean, even as a traditional loan officer, I was hard pressed to find anybody over the age of 40 that didn't have a HELOC in place. Yet when you say reverse mortgage, it's a stumbling block for a lot of people, and they kind of put a wall up. And if they just realize you're already using home equity in so many different ways, but this is just a safe way to go about it because you don't have that required payment. And like you said, the growth on the line of credit and the white paper uses, it can be very strategic.
When I think about people who probably shouldn't consider it, the two that come to mind, there may be others, but the two that come to mind to me are obviously someone that knows they're not going to be in the house much longer. If you're planning on selling the house in the next 5 or 6 years, it probably doesn't make sense to put one of these products on because the non-recourse is a huge benefit, but it comes at a cost. You pay a premium. You pay a premium for that. Now, if you use it like a strategic borrower, that's a benefit because you're going to let that line of credit grow at that higher rate. So it's actually a good thing if you are putting it in place to have that growing line of credit. It just means the line of credit grows longer. But if you're planning on selling the home in the next couple of 4 or 5 years, you do have closing costs, you do have things you have to absorb, and you've got to be in it long enough to make it worthwhile. It seems to me. The second one, I think, I believe, we avoid debt. We want our clients to be debt free. And this might be an asterisk to that, but I still don't want people that haven't demonstrated an ability to be responsible to do one, because really it's a strategic retirement income strategy. It's not a strategy that I think is well advised to people who are likely to, increase their lifestyle frivolously because they have it, because you can get into some trouble, just like we all can, with spending that's not because the loan does have to be paid back by somebody, either the house or the non-recourse nature, but you just don't want to create stress. You want to the whole purpose of the product is to create peace of mind. And if you use it frivolously and you start seeing that loan balance, it could do just the opposite if you're not being very strategic with it and managing the remaining equity. Do you agree?
100% you're correct. Those costs that are incurred with putting the loan in place need time to kind of amortize out for it to make sense. So just like I would never advise someone to refinance a home at a lower interest rate if they were moving in 3 years. It takes time to reap the benefit from that lower interest rate because it costs to refinance. So you're right on that. And then definitely financial responsibility. I mean, just like credit cards, you have those group of people that use credit cards as a benefit, and they're paying for everything with a credit card, incurring points, using that for free travel, and they use it responsibly. And then you have those that find themselves in a mountain of debt. So I think as an advisor, most people probably have a little bit of a pulse on, what the financial mentality is of the client. And yeah, it's definitely not implemented that way where it's just going to create a bigger problem in the end.
Yeah. So let's talk about the cost. What are the costs relative to a traditional mortgage? What's different in terms of the way the cost, we're all kind of familiar with closing costs and points and the interest rate. Our reverse mortgage is different.
So the main difference is going to be that mortgage insurance protection. So that right now, the way that is structured is it's going to be 2% of the appraised value of the home. So if you're looking at an $800,000 home, you've got $16,000 in closing costs tacked onto your closing costs for that mortgage insurance protection. So that's going to be the biggie. And then going forward throughout the life of the loan, it's only 0.5% of the loan balance. So it's much reduced, but you pay that big chunk up front. And, there's a reason for that. And it helps keep the program solvent and in place. And again, will kick in if there's any kind of problem in the end where the home is not worth as much as the loan is. But that's the big one with reverse is that insurance protection.
Yeah. So again, that's the area that requires a lot of education because you see the closing cost and, people's eyes glaze over, but that's the benefit because it's non-recourse. I mean, that's what makes it non-recourse. And that's what makes the line of credit grow faster as well. So let me just see if I can repeat what you just said. So the annual interest cost is approximately 0.5% more than a traditional mortgage in the marketplace. 50 basis points, right? 0.5%, the premium.
It's 0.5% of the loan balance going forward. So whatever, not related to other loans, but whatever the loan balance is, it's 0.5% of that going forward.
Okay. In addition to the normal interest rate.
Correct.
Okay. Right.
Yes.
Yeah. So it's 2% up front and then an extra 0.5% ongoing to cover the insurance.
Is the total interest rate attached to the loan. Yeah. The MIP, the mortgage insurance protection, is 0.5%, 50 basis points tacked on. Yep. And that's what the line of credit will grow at and loan balance. That's what you're saying. Yes.
Yeah, correct. Well, this has been really helpful. How do people, other than working with an advisor has a little bit of information on these products and can connect them with experts like you, how would someone watching this show learn more on their own? What would be a good resource for them to find out more about HECMs and if they want to really dig in and find out how they work and whether it might be appropriate for their circumstances?
I am definitely a resource. So that is, like I said, my passion, and any opportunity to educate and enlighten on the reverse mortgage product, they can feel free to reach out to me. And that's what I'm there for. And if they decide to move forward in the loan process, then assign it to one of our talented loan officers to take it from there.
Okay. And then are there other, so on your website, is there educational information there if they wanted to I just kind of do some of my own reading or research.
Yeah, they can go to the website and watch videos that explain a reverse mortgage, look at, some literature on disputing the other myths that exist about it. So yeah, and they can do that at Finance of America, just spelled out .com.
financeofamerica.com. Okay. And what is the best way for them to reach out to you? Is it just go to that website?
You know what? I'm going to share my email, and that would be Gabrielle.Welter at financeofamerica.com, all spelled out. It's a long one.
Okay.
And so, yeah, you just email me. Yeah, I love talking about it, and I'll answer any questions.
Okay. Okay, very cool. Is there anything else you'd like to share that we didn't cover that might be helpful to the audience?
I think we covered all of it. Just the fact that Illustrator tool is a great opportunity to kind of, sometimes it's easier to see it, see it on paper, or see it on the screen, how the numbers play out. And that's a real quick, easy run through that I can share with somebody. The other thing, I guess, Jeff, would be we do have webinars monthly that people can jump on, and they'll find that at the financeofamerica.com too. So if somebody wants to learn more, they can hop on a webinar.
Oh, that's fantastic. Well, I appreciate your being on today. Like I said, we try to think holistically about a balance sheet, and these products are obviously not right for everybody, but there are some people that probably ought to take another look at them because they're not just a last resort. They can be a strategic tool in your quiver as you address some of these challenges that we face as we move into retirement. And I think it should be, obviously, everything has a need. And so you just got to figure out, is it right for your particular circumstances? And again, I'm not terribly objective about this, but I think a qualified advisor can be helpful as well as you go through some of that analysis. So thank you all for joining me today. Gabrielle, thanks so much again. You're fantastic. Really appreciate all the help you've given our firm as we continue to try to learn more and be a resource to our clients when it comes to all things HECM or reverse. And for our audience, thanks so much for joining us today. I hope you found some value in today's show. If so, check us out on past shows on all the streaming platforms. Please give us a rating and give me some feedback. I can be reached at moneyandmeaning@tandemgrowth.com. So again, thanks and have a great day. And we look forward to seeing you next time. Thank you all.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.